What if I told you that one of the world's fastest growing, most transformative industries is trading at a 70% discount? And no, it's not a startup or a speculative bubble. I'm talking about Chinese internet stocks, a sector that's been battered by regulatory fears, geopolitical tensions, and Western capital flight. But beneath the negative headlines lies a remarkable story of resilience, growth, and opportunity. These companies are driving China's digital revolution and reshaping global e-commerce markets, all while trading at prices that scream undervalued. In today's video, we'll break down why Chinese internet stocks are such an underrated investment opportunity, how they fit into China's broader economic strategy, and why now could be the perfect time to invest. Let's start with the obvious question. Why Chinese internet stocks? The answer lies in valuation. Chinese internet giants like Alibaba, Tencent, and JD.com have seen their stock prices fall as much as 70% from their 2021 highs. That's a massive drop, but here's the kicker. Earnings for many of these companies have remained strong or even grown during this time. The results? These stocks are now trading at price-to-earnings ratios as low as 10x or 12x, a far cry from the bloated 40x valuations we saw just a few years ago. This mismatch between earnings and stock prices creates a unique margin of safety. Investors willing to look past the noise can buy into companies with solid fundamentals at dirt-cheap prices. In investment terms, this is the definition of a contrarian opportunity, where pessimism, not performance, has driven valuations to irrational lows. So what's exactly behind the sell-off? The short answer is fear. Western investors have largely abandoned Chinese equities in general, spooked by a mix of regulatory crackdowns, geopolitical tensions, like concerns over Taiwan, and economic slowdown narratives. The result has been indiscriminate selling, creating a vacuum of capital and pushing valuations to rock-bottom levels. But here's the reality. These fears are overstated. China's regulatory cycle, while painful, was aimed at creating long-term market stability. Now, with the regulatory peak behind us, these companies are shifting their focus back to core operations, innovation, and shareholder returns. And those geopolitical concerns? While they can't be ignored, they've had little impact on the day-to-day operations of China's tech giants, which are deeply entrenched in the country's domestic and regional markets. Zooming out, there's an even bigger story unfolding. China's transition from an export-driven economy to one centered on domestic consumption. Over the past decade, China has cultivated a massive middle class with growing disposable income and an insatiable appetite for digital goods and services. E-commerce platforms, fintech providers, and digital entertainment companies are thriving in this environment, catering to an audience of over 1 billion internet users. But it doesn't stop there. Chinese companies are also expanding aggressively into ASEAN markets. Countries like Indonesia, Vietnam, and Thailand, where they're becoming dominant players in rapidly growing economies. This regional diversification not only boosts revenue, but also insulates these companies from domestic fluctuations. This video is produced by the team at Capitalist Exploits. Headed by professional asset managers Chris McIntosh and Brad McFadden, the team hunts for deep value assets that are surprisingly contrarian despite strong fundamental cases for potential future appreciation. If you're looking to gain access and insight as to the personal investments of active hedge fund managers and in-depth reasoning as to why they've invested in the assets they're sharing, check the links in the description below. You'll get access to advice on how to allocate, organize, and think about your portfolio, while joining a growing community of people thinking outside of the box. Enjoy monthly updates, open Q&As, regular newsletters, a community forum, organized portfolios, investing education videos, and more with the Capitalist Exploits Insider subscription. If you're not ready to fully take the leap, we also offer the Capitalist Exploits Insider newsletter series for $1 for the first 30 days and $35 a month thereafter. Do note, our investing strategy and philosophy can deviate a lot from the mainstream. We offer a money-back guarantee regardless, but make sure you're on board with our investing philosophy and global outlook before deciding to join us. Another key piece of the puzzle is policy support. The Chinese government is rolling out a series of economic stimulus measures, from interest rate cuts to financial relief for local governments. These moves are designed to stabilize growth, and internet companies stand to benefit disproportionately. Why? Because their high growth business models thrive in an environment of lower borrowing costs and increased consumer spending. Moreover, the government's regulatory pivot towards stability signals a broader commitment to restoring investor confidence. After years of crackdowns, policymakers are now incentivized to promote a healthy market environment, knowing that robust tech companies are critical to China's long-term economic strategy. Here's what makes this sector even more appealing: financial strength. Many of China's internet giants are cash-rich, generating strong free cash flow that not only stabilizes operations, but also enhances shareholder returns. Companies like Alibaba and Tencent are leading the charge with aggressive share buyback programs and even dividends. This financial resilience provides a buffer against market volatility, giving these companies the flexibility to invest in growth opportunities while rewarding investors. And with valuations at historic lows, these buybacks are effectively creating more value per dollar spent. Chinese internet stocks also offer a unique diversification benefit. They have a low correlation with US tech stocks and broader indices like the S&P 500, making them a valuable addition to a well-rounded portfolio. And while regulatory risks have dominated headlines, we argue that these fears are largely overblown. With the regulatory cycle now in the rearview mirror, the sector is entering a period of recovery and growth, backed by structural tailwinds like rising consumer demand and regional expansion. Timing is everything in investing, and the case for Chinese internet stocks is no exception. The combination of low valuations, robust earnings growth, and easing regulatory pressures makes this a rare window of opportunity. As global markets grapple with inflation, recession fears, and geopolitical uncertainty, Chinese internet stocks stand out as a contrarian bet with significant upside potential. But this opportunity won't last forever. As sentiment shifts and more investors recognize the value in this beaten down sector, valuations are likely to rebound quickly. Early movers stand to benefit the most, capturing outsized returns as the market corrects itself. With all that said, Chinese internet stocks represent one of the most compelling investment opportunities in today's global markets. Despite the fear-driven sell-offs and geopolitical noise, the fundamentals tell a much different story. For investors willing to adopt a contrarian mindset and look beyond short-term volatility, Chinese internet stocks offer a rare blend of value, growth, and diversification. If you want to learn more about how exactly we're positioning ourselves at Capitalist Exploits to capitalize on this opportunity, check out the links in the description below and gain access to the specific plays we're looking at and even more in-depth discussion and rationale about the Chinese e-commerce sector. The research used in this video is also available in the description below, and thank you so much for watching, and remember to stay informed.